In this chapter, we're going to take a first look at options, and we're going to derive one of the most important formulas for options, which is called the put-call parity. If you compare options to forward contracts, then the key difference is that at the maturity date of the option, you don't actually have to go through with the trade, but if you are the owner of the option, then you have the choice to decide whether you want to trade or you don't want to trade. While remember, with the forward contract, you at the initial time agree that at the maturity date, you're going to trade an underlying asset. In addition to that, because the owner can actually decide whether he wants to trade at the maturity date, that means that there will be some value of the option at the initial date when the option contract is signed. And therefore, the owner or the buyer of the option will have to pay the seller or the writer of the option some amount of money. This is again in contrast to forward contract, where we chose the forward price exactly such that for both long and short positions, the present value of the future cash flows was exactly zero, and therefore no one had to pay the other party some money at the initial date. Essentially, we have two different types of options. One is called the call option and the other one is a put option. In a call option, the owner or the long position has the right, but again, not the obligation, to buy the underlying asset at the maturity date for a fixed price, and we call this fixed price the strike price of the option, which we denote by K in our course. So therefore, at the maturity date, the owner can decide whether he wants to buy that underlying or not. And if he buys the underlying, he pays K dollars and he receives the underlying, which is worth S at time capital T. Therefore, you're only going to do that as the long position in that call option if the price of the underlying S is larger than the strike price. If on the other side, the price of the underlying is worth less than the strike price, then you better decide that you don't want to trade. So you do not want to buy something which is worth less than K dollars for a fixed price of K dollars. Therefore, the payoff for that long position in the call option is going to be the maximum between ST minus K and 0. So again, if ST is larger than K, then this is positive. That's then what you receive if you exercise that option. But if this is negative, so if ST is less than K, then the owner of the option says, I don't want to trade, and therefore there's just a zero payoff. On the other side, the writer or seller of the call option, we also call this position the short position. She cannot choose whether she wants to trade at the maturity date and just has to do whatever the long position decides. And again, we know that the long position will actually buy the underlying asset at strike price K only if the underlying is worth more than that. And therefore, the payoff is exactly opposite of the long position. It's minus the maximum of ST minus K or 0. So notice that here we always have either a negative cash flow. So again, if the long position decides to exercise the call option and ST is larger than K, so then this is a positive term, and multiplied by a minus, that means we have a negative cash flow. And whenever the price of the underlying is less than K, that would actually be good for the short position in the call option. But then we know that the long position decides she doesn't want to trade, and therefore there's a zero cash flow. And then also for the short position in the call, there is going to be no payoff. You can also rewrite this minus the maximum as the minimum of K minus ST or 0. Notice that because the short position always has a negative or a zero payoff and the long position always has a positive or a zero payoff, it must mean that the short position will only be willing to enter this contract originally if the long position pays some money to the short position. And that amount of money which the long position pays the short position, that is equal to the value of the option. And our task in this class will be to figure out what is the fair value of that option, or what is that amount which the long position should pay the short position. I would like to very quickly move to the virtual whiteboard to illustrate what the payoff diagram of a call option looks like. On the horizontal axis, we're going to draw the value of the underlying asset at the maturity date, capital T. And on the vertical axis, we're going to draw the payoff. If you have a call option with a strike price K, then if the price of the underlying ends up less than K, then the owner of the call option does not want to exercise that call option because you do not want to pay strike price K for an asset which is worth less than K, and therefore the option is going to expire worthlessly and the payoff is equal to 0. However, if the price of the underlying asset is above K, then the owner of the call option is going to exercise and she pays K dollars and receives the underlying which is worth ST dollars, and therefore for every dollar of ST above K, the payoff is going to be equal to $1, or in other words, the payoff is an increasing 45-degree line. Moreover, you see now that the payoff is always either 0 or positive. It must be that the long position pays an initial price for that call option. And therefore, we can also look at the profit. And the profit is just a parallel downward shift of that red curve. Notice that the downward shift is equal to the initial call price multiplied by the gross return of the risk-free asset from small t to the maturity date, or in other words, the future value of the initial call price which the long position has to pay the short position. Notice that the call option loses money if the price of the underlying ends up at the strike price or below, and it starts to make gains if the price of the underlying ends up above the strike price. The put option is similar to the call option, but instead of that, the owner or long position has the right to buy. With the put option, you have the right to sell the underlying asset at that maturity date at the pre-specified price K, which again we call the strike price of the option. Now here, the owner or the long position of the put will decide to exercise the option if the price of the underlying S is less than the strike price. So he would like to deliver that underlying asset and receive the fixed price K if and only if that underlying is worth less than K. If the price of the underlying S is larger than K, then a long position will decide, no, I do not want to deliver that underlying asset, which is now relatively expensive, and receive only strike price K. And therefore, the long position then doesn't exercise the option and the payoff is going to be 0. The payoff is going to be the maximum of either K minus S or 0. So again, when K is larger than S, then you want to exercise, you do want to deliver something which is relatively cheap and receive that fixed price K. But if the price of the underlying is higher than K, well, then you do not want to deliver that expensive asset and receive only K. So in that case, when that is negative, then as a long position, you decide, I do not want to sell, and therefore the payoff is just 0 and the option expires worthless. On the other side, we have again the writer or the seller of the put option. We also call this the short position. And the short position doesn't have any right to decide, but just has to buy the underlying asset whenever the long position decides that she wants to sell. And therefore, the payoff is again the opposite of just a long position, which is minus the maximum of K minus S or 0. And you can again rewrite it as the minimum of S minus K or 0. So if that underlying is worth less than the strike price, then we know that the long position wants to deliver that underlying and receive the strike price, and therefore now the short position has to pay the strike price and receive that relatively cheaper underlying asset and gets therefore a negative payoff. And on the other side, we know that if the price of the underlying is higher than the strike price, then the long position will not want to sell that underlying asset at a relatively low strike price, and therefore the short position cannot buy the underlying asset and the option is worthless and the payoff is 0. Notice again that for the put option, the long position always has either a positive or a zero cash flow, while the short position always either has a negative or a zero cash flow. Again, similar like with the call option, a short position would only want to enter that put option contract if at the initial date the long position pays some money to the short position. And that amount of money will be exactly equal to the fair value of the option. Let me again move very quickly to the virtual whiteboard to illustrate what the payoff of a put option looks like. Again, if on the horizontal axis we have the price of the underlying asset at the maturity date, capital T, and on the vertical axis we have the payoff for a put option. If the price of the underlying asset is above the strike price K, then the long position in the put option does not want to exercise the put because she doesn't want to deliver the underlying asset and receive strike price K. That would mean a loss. And therefore the payoff of the put option is zero if the price of the underlying is above K. And if the price of the underlying is below K, now the long position in the put option wants to exercise and deliver the underlying asset, which is worth less than K, and receive the fixed strike price K. And for every dollar for which S is below K, the put option earns $1, and therefore the payoff is again a 45-degree line. Similar as with the call option, we notice that the put option always has a positive payoff or a zero payoff, and therefore again a short position is only willing to enter that contract if initially the long position in the put option pays some money to the short position, and that money is exactly equal to the price of the put option. And again, to determine the profit, what we can do is just move that blue payoff line of the put option downward. And so therefore the long position in the put option makes a loss if the price of the underlying ends up at the strike price or above. And he starts to make gains if the price of the underlying drops sufficiently. We have several different types of options, but the most popular ones are European and American options. American options give the long position the right to exercise the option anytime before the maturity date. So for the call option, anytime before we reach the maturity date, the long position could decide, now I would like to buy that underlying asset at the strike price K. Or for the put option, the long position could decide anytime before maturity, now I would like to deliver that underlying asset and receive the fixed strike price K. With a European option, the long position can only make this decision of exercising the option at the maturity date. We see immediately by comparing American and European option, the American option gives more flexibility to the long position and therefore it should be more valuable. Notice that most exchange-traded options are American options. However, because European options are generally easier to value, in our course, we're gonna mostly focus on European options, but we do talk a little bit about extensions of how we can find the American option price as well. Options are traded both over the counter and on exchanges. And of course, again, as with the forward and futures contracts, if something is traded over the counter, then there is more flexibility with the choice of the underlying assets and also with particularities of the contracts. On the other side, exchange-traded options might be easier to trade, especially for smaller investors who are otherwise not very well connected. In addition, we have all the other differences between over-the-counter traded and exchange-traded contracts, such as regulation and potential default risks. The underlyings for options can be almost anything. In our course, we mostly focus on stocks and stock indices, but you can also have options written on interest rates or equivalently bond prices, on foreign currencies, so that means options on an exchange rate, or you could have options written on another derivative, such as on a futures contract or perhaps a swap contract, or it is also very popular to have options written on some real estate. Notice that in our course, we only focus on valuing financial contracts, so actually finding the fair value of an option which is traded. But you could also use the same concepts which we learn here for evaluating real options. Real options are projects of corporations where there might be some value for the corporation to wait until to a later date to decide whether they want to take some action or not. In our course, we're not going to go into the details of real options, but there are other corporate finance courses where you can learn about real options. In option markets, similar to other derivative markets, we typically see market makers. These are traders who provide liquidity, meaning that they're always available to trade, and therefore it makes it easier for other traders to enter either long or short positions. And these market makers would always quote two prices, a bid and an ask price. And basically the idea is that the market maker is willing to pay less to buy an option than the price they require to sell you an option. Now, why are you willing to trade with these market makers? Well, first of all, they can earn that spread because they're always there for you to trade. So you don't have to wait until someone else enters the market. So it helps you to make trading easier, and therefore you're willing to pay some fee for that. On the other side, market makers are also exposed to certain risks. So imagine they enter a position with you, but they cannot immediately enter an offsetting position with another party and therefore earn that risk-free spread between bid and ask prices. But maybe they have to wait a little bit until another position is interested in offsetting position of what they entered with you. And during that time horizon, prices may change, and that exposes that market maker to risk. Of course, market makers can also use other contracts to hedge their risks, not only an exact offsetting option contract, but this type of hedging is also somewhat more involved and could be costly. And again, to be compensated for these costs, they demand to earn a spread when they trade with you. Usually when there are a lot of market makers in a market available, then there is more competition and also more liquidity. And that is good for small investors like you and me, because then typically the bid-ask spread becomes smaller and therefore our effective costs of trading are lower. If you trade an option on an exchange, then there might be margin requirements if you take the short position in an option. The idea is that if you're a long position in an option, we know for sure that your payoffs are never going to be negative in the future. So you always either make a profit or have a zero payoff. And therefore, there's no reason for an exchange to ask a long position to put down some collateral. However, if you write an option, so if you are the short position, then you receive some money today, but in the future, we know that for sure you're never going to have a positive payoff. So either your payoff is zero or you have a liability. And the exchange wants to make sure that you're always going to be able to pay for that liability. And therefore, the exchange requires you deposit some money in a margin account to cover all possible liabilities in the future and make sure that you're never going to default. Of course, a broker may adjust your margin requirements depending on what strategy you have. So if you sell, for example, a call option, and on the other side, you already own the underlying asset. So for sure, in the future, you can deliver that if the long position decides to buy it at the strike price. Well, then there's really no need to have high margin requirements because for sure, you will be able to satisfy your liability. And therefore, a broker may ask you for less collateral than if you just sell an option without having any offsetting position. Other than that, there are only margin requirements for the short position. Exchange-traded options are organized quite similar to exchange-traded futures markets. So for example, an option position can be closed out early. For instance, if you have a long position in a call option and at a later date you enter a short position in exactly the same call option, then the exchange would just cancel out your both positions. Moreover, similar to futures contracts, when an option is exercised, then the clearinghouse will just randomly select one of the open short positions in that option to match it with the long position. So if you enter a long or a short position in an exchange-traded options contract, then you actually don't know who is going to be your counterparty until the option is actually exercised. Next, I want to talk about a few specific types of call options. Notice first that anyone could sell a call option. So imagine a call option written on Microsoft. I could take the short position, and let's suppose you are the long position. Once you exercise that call option on Microsoft, then I would just simply go to the market, buy some Microsoft stocks, and then deliver them to you. Now, with our first example of warrants, here the situation is quite different. A warrant can only be issued by the company which also issues the stock. So if you have a warrant written on Microsoft, then only Microsoft itself could issue a warrant. The reason for that is because once a warrant is exercised, then Microsoft would issue new stocks to deliver them to the long position of the warrant. And therefore, only Microsoft can be the short position of that warrant because no one else would be allowed to issue new Microsoft stocks. Now, there is an important effect of exercising a warrant because new stocks are issued. That means that the number of stocks outstanding will increase. And if the overall company value doesn't change when that warrant is exercised, then an increase in number of stocks which are outstanding means that the value per stock will decrease. And this is a dilution effect in these stocks. Therefore, issuing a warrant has some implications on the actual underlying stock price, while exercising a regular call option where no new stocks are issued will not have such a dilutive effect on the stock price. Another difference between typical call options and warrants is the time to maturity. For a typical call option traded on an exchange, the time to maturity is just a few months. For some call options traded over the counter, maybe you see sometimes maturities for a few years. But for warrants, we typically have very long times to maturity. So something like of the order of 15 years. Notice that usually warrants are issued together with bonds. So that means a company typically wants to borrow money, and to make it more attractive to lenders, they would also give these lenders some warrants. Why is this attractive? Well, it gives the lender also the opportunity to become a stockholder in case the stock price increases a lot. And therefore, these owners of the warrants have some upside potential to the stock price. In contrast, if you otherwise just lend to the company, then it doesn't really matter to you whether this company becomes the next unicorn or whether they just do well enough to pay off their interest and debt. Because warrants are valuable, if you sell them together with bonds, that means that you can lowering the interest rates effectively. A similar type of call options are convertible bonds. So here the company would borrow money, but the lender has the opportunity to return the bonds and in exchange ask for equity. This is similar like having bonds and warrants issued together. Again, the lender has some upside potential to the company if the stock price increases a lot. But the difference between a package of warrants and bonds versus convertible bonds is that once you exercise the convertible bond, the bond disappears and just new equity is issued to this original lender in the convertible bond. On the other side, with a package of bonds and warrants, if a warrant is exercised, the long position in the warrant will have to pay some money equal to the strike price in the warrant and receive the newly issued stocks, but that investor still keeps his bonds. With convertible bonds, if you compare them to normal lending, then interest rates of convertible bonds will be lower because the investor will have this upside potential in case the stock price increases a lot. He has the opportunity to exchange the bond for stocks. The last type of special call options are employee stock options. These are substitutes for paying normal salary to employees. An employee instead gets some options, and if the price of the stock increases a lot, then they can exercise that option and get a positive payoff. Employee stock options typically have long time to maturity, so 10 years or more are not uncommon. In addition to that, it is typical for employee stock options to have a vesting period of a few years, meaning that if an employee quits his job before that vesting period expires, then the employee stock options are worthless. This gives incentives to employees to stay longer with an employer, and therefore it provides more stability for the company. Notice that employee stock options make a lot of sense if they are issued to employees who actually matter to increase the value of a company. So typically that would be for CEO or other upper management, because their effort matters a lot for the actual company value. Employee stock options are similar to warrants and convertible bonds in the sense that once an employee exercises the employee stock options, then the company will issue new stocks, and therefore the number of stocks outstanding increases, which again has a negative dilutive effect on the stock price. Nowadays, when companies award employee stock options to an employee, then they have to actually report true market value of that employee stock option, and this will then be used both for accounting purposes and also to determine the tax which an employee has to pay on his salary. However, in earlier days, it used to be the case that the value of the option which was awarded was determined as what the employee would get right now if he exercised that option. So therefore, if the strike price was set equal to the current price of that stock, then the employee basically was considered to get a zero salary with these employee stock options, and therefore didn't have to pay any tax on it. This is of course wrong, because the value of an option is much higher than the current amount of money which you could get from exercising, because again, with an option, you can wait and see if the stock price increases in the future, then you exercise and get a positive payoff. But if the stock price decreases, then you don't have any liability and you can just let that option expire. So since the payoff in the future is always positive or zero, then the present value definitely should be more than zero. Let me just take very quick some time talking about notation, which we're going to use later in this course a lot. So for the underlying asset, similar to when we talked about futures and forward, we're going to write that by S. That's the price of the underlying asset. Then we denote the maturity date of an option by capital T, and we denote the strike or exercise price of an option by K. The current price or the current value of an option, which the long position has to pay to the short position to enter the option contract, we denote either by OT for option price, or by CT for the call price, or PT for the put price. And then of course we have to specify whether we look at European or American options, or potentially some other exotic options. Notice that exotic options, that's just going to be covered in the very last chapter of our course. Other important variables which we're going to use is the volatility of the underlying asset price. So the volatility sigma measures by how much the underlying asset price may increase or decrease in the future. So it measures this dispersion of that underlying asset price. Similar to what we did before in the course, capital D between small t and capital T, that's the present value of all the dividends which you earn between now and the maturity date of the option. Then finally, we have the risk-free asset. And for most of our discussions, we actually assume that the risk-free rate is going to be constant, and we denote it by R. If we don't need the assumption of the risk-free rate to be constant, then we just denote it as usual by a spot rate, where we indicate by the time index T in the subscript of R. The moneyness of an option tells you how much money you would get right now if you were at maturity. And so we call a call option in the money if currently the price of the underlying asset is above the strike price. And again, if you are now at the maturity date, then you would want to exercise that call option, and your payoff would be just S minus K. An option is called at the money if the price of the underlying is exactly equal to the strike price. And if you were now at maturity, then you wouldn't care whether you exercise or not, because your payoff is zero anyways. A call option is out of the money if the price of the underlying is less than the strike price K. And if you were now at the maturity date, then you would not want to exercise your option because you do not want to pay K dollars to receive an underlying which is worth less than that. Deep in or deep out of the money just means that that difference between the underlying price S and the strike price K is large. You only exercise a call option if it is in the money. Similar for a put option, we say a put option is in the money if the price of the underlying is less than the strike price. So if you are at maturity, then you only want to sell that underlying asset if it is actually worth less than the strike price which you receive. We call the put option at the money if the price of the underlying is exactly equal to the strike price. So you don't care whether you exercise and sell that underlying asset at strike price or not. And we call the put option out of the money if the price of the underlying is larger than the strike price. So in these cases, you definitely do not want to deliver that underlying asset, which is worth S, and only receive the strike price K. Deep in and out of the money, again, here is we just consider a large difference between the strike price and the underlying asset S. A put option is only exercised at the maturity date if it is in the money, so that you receive a relatively high fixed strike price compared to the underlying which you're going to deliver. Next, we're going to talk about intrinsic value and time value of an option. The intrinsic value is the amount of money which you get if you were right now at maturity. So for a call option, the intrinsic value is equal to the maximum of either 0 or the price of the underlying asset minus the strike price. For a put option, the intrinsic value is the maximum of either 0 or strike price minus the price of the underlying asset. The time value of an option determines the cherry-picking right of the long position to decide whether he wants to trade or not at a later date. Eventually, the current value of an option, or the total value, is equal to the intrinsic value plus the time value of the option. To illustrate this, let's consider a European call option with strike price K equals to $75. Then the blue line would be the payoff of that option if you are at the maturity date, or equivalently, if you're before the maturity date, then that blue line is the intrinsic value of the option. So what does it mean? If the price of the underlying, which I plot here on the horizontal axis, if it is less than $75, let's say, for example, it's $25, then the intrinsic value is 0, because if you were now at maturity, then you do not want to exercise the call option. You do not want to pay $75 for something which is worth only $25. If, however, let's say the price of the underlying is $100, then if you were at maturity, you would want to exercise the option. You want to pay $75 for something worth $100, and your payoff in particular would be $25, and that's what I plot over here. So you have an intrinsic value equal to 0 for the call option until to the strike price, and after that, that intrinsic value increases at the 45-degree line. Now the red line determines the total value of an option, and therefore the difference between the red line and the blue line gives you the time value of that call option. You notice that the time value of the call option is the largest if you are somewhere close to the strike price. And the reason is because if you're very close to the strike price, then the cherry picking right is the largest, because the price may very well decrease below 75 or increase above 75. And depending on what's going to happen in the future, I then want to decide whether I want to buy at 75 or not. If, however, the price of the underlying was very low, so very close to 0, then anyway, we know the price of the underlying is never going to end up above 75, and therefore we know for sure we're never going to exercise that option, and there is really not much value in waiting. On the other side, if the price of the underlying is very high, then the chances that the price will drop below 75 again is very low, and therefore the value of waiting and deferring that decision when we want to exercise will be very small. Now we see here also a green dotted line, which is somewhat higher than the blue intrinsic value and which gives us some lower bound for the option price. To explain this lower bound, let's look at a timeline from small t to time capital T. If you look at the call option, it has a current price CT today. And at maturity, if the price of the underlying is larger than K, then we're going to exercise that call option and the payoff is going to be ST, which you receive, minus the strike price, which you pay, K. And if ST is less than K, then we are not going to exercise the option and the payoff is 0. Now compare these to a strategy where you buy the underlying asset and pay ST dollar today, and you borrow the present value of K dollars. So that means today you have to pay ST dollars and you receive this many dollars. So the total amount of money which you have to pay is ST minus the present value of K. This means in the future, you own the underlying asset, which is worth ST dollars. And on the other side, because you borrowed the present value of K, you have to pay back K dollars. And this is true both if ST is larger than K or if ST is less than K. Notice that in the second case where ST is less than K, then this thing is actually less than 0. So we see that if ST is larger than K, then the two payoffs are exactly identical. But if ST is less than K, then the call option has 0 value where the other strategy has a negative payoff. And therefore the call option has always either the same or a higher payoff than this alternative strategy. This therefore implies that the price of the call option has to be larger or equal than the price of the underlying asset minus that present value of K dollars. Therefore, we have derived a lower bound of the call option, and notice that this lower bound is larger than ST minus K, assuming that the risk-free rate is positive. And this is what I draw here with this green dotted line. That's exactly this ST minus the present value of K or 0. So the lower bound for any call option would be either 0 value or ST minus the present value of K. So therefore, the true call price, which is the cherry picking right of the option, so of deferring that decision whether you want to exercise or not, on top of that lower bound, that will then be given by that red line. Notice that this picture is only true for an option which doesn't pay any dividends, because if the underlying pays some dividends, then the price of the underlying will drop as the company pays out some dividends. And this may have a negative effect on the call price. And therefore, the call price might be less than the price of the underlying asset minus that present value of the strike price. Notice that if the stock doesn't pay any dividends, then the time value of the call option is always positive, as again, the lower bound is above the intrinsic value, and on top of that, you have that cherry picking right of the call option, and therefore, you never want to exercise that option early, because exercising early would mean that your payoff would be just equal to the intrinsic value. Therefore, an American call option, if there are no dividend payments, will always be exercised only at the maturity date, and therefore an American call option price will be exactly equal to a European call option price. Next, let's look at an example of a put option. I draw again the blue line, which is the intrinsic value. So if you have a put option with a strike price of $75, if the price of the underlying is above $75, if you were at maturity, then you do not want to exercise that option, because you do not want to deliver something worth more than $75 and only receive a strike price of $75. But if the price of the underlying is below $75, so let's take, for example, $25, then you would want to deliver that asset for $25 and receive the strike price of $75, which gives you a payoff of $50. And that's exactly the value which I plot over here, an intrinsic value of $50. Now the put price will be given by this red line. And notice here the put price can actually be less than its intrinsic value. And this is because the lower bound, which we're going to derive very similar to the previous example for the call price, will actually be less than the intrinsic value. So let's look at this first. Let's draw again a timeline from small t to time capital T. If you have a put option, which costs PT dollars today, then if the price of the underlying in the future is larger than K dollars, then you're not gonna exercise that put option and its payoff is 0. But if the price of the underlying is less than K dollars, then you exercise the put option and you receive K minus ST dollars. Now let's compare this to a strategy where we short sell the underlying asset and invest the present value of K dollars. So we have to pay today the amount of money which we lend minus the amount of money which we get from short selling that underlying asset. This strategy for sure in the future will yield us K dollars, and on the other side we have to close our short position from short selling the underlying asset, which costs us ST dollars. Notice that in the case when S is less than K, then the payoff is exactly the same of these two strategies of buying either a put option or lending the present value of K dollars and short selling the underlying asset. But in the case where S is larger than K, we get a negative payoff from lending money and short selling the underlying asset, while the payoff of the long put option is 0. Therefore, the put option has a more attractive payoff than this alternative strategy, which means that the price of the put option has to be larger or equal than the price which you pay for lending money and short selling the underlying asset. But notice that the present value of K minus the current price of the underlying asset is less than the intrinsic value if ST is less than K and if the interest rate is positive. And therefore, the lower bound for the put option is now below the intrinsic value. Notice, however, the lower bound has still a lower bound of 0 because, again, we know that the put price will always be positive as its future payoff will always be 0 or positive. So the put price can never go negative. What does this mean now? So if you draw the total put price given by this red curved line over here, that can now be below the intrinsic value. And this is the case if the price of the underlying is very low, because here again, the cherry picking right doesn't really have much value. We anyway know that we want to exercise that option because there's almost no chance that the price of the underlying will be ever again above 75. But now with the put option, if you have to wait until to the maturity date, then we only receive that strike price in the future. And then discounting that strike price actually lowers our value than if you would exercise it already today. So then the put price actually has a lower value than the intrinsic value. On the other side, if you are somewhere close to at the money, so if the price of the underlying is close to the strike price, then the cherry picking right can actually be quite large. So here we don't know whether we're going to end up in the money or out of the money at the maturity date. And therefore it's valuable to wait with the decision before we decide whether we want to exercise or not. And if that cherry picking right is large enough to offset that discounting of the strike price, which lowers the lower bound, then the put price can actually be above the intrinsic value. Notice that this is interesting if you think about an American option, because for an American option, you could exercise before the maturity date, and you would want to do that in case if the intrinsic value is higher than the equivalent value of holding on to the option until to the maturity. And this is the case if the price of the underlying is low enough, because at any of these low prices, we know anyway that we exercise the option in the future. And therefore, it is actually better to exercise right now that option, because then we receive strike price K right now and deliver that underlying asset, versus waiting until to the maturity date where we get the strike price at the later date. And therefore, if we evaluate the value today, we need to discount that strike price and therefore receive less value. So therefore, whenever the red line is below the intrinsic value, that's when the time value of the put option is negative. And again, that's because there is a lot of discounting of the strike price. In these cases, we would want to exercise the American option early, and the European option is actually worth less than American option. On the other side, if the price of the underlying is above that threshold, in these cases, the time value of the put option is positive, and therefore you do not want to exercise the American option early. Next, we want to look at one of the most important equations for options, and that's the put-call parity. When we try to find the fair value of an option, then we're going to use the same idea as we used for forward and futures prices. We use replication arguments. So remember, to determine the forward price, we said that a long position in a forward contract is exactly the same as buying the underlying asset and borrow some money. And similar here, when we try to find the value of an option, we'll try to find a portfolio which perfectly replicates that option. And then that price to buy that portfolio will determine the value of the option. Now, there are two different ways to do that. In the next chapter, we're going to talk about how to replicate the price of an option using a portfolio which will be rebalanced on a frequent basis. And that portfolio consists of the underlying asset and the risk-free asset. So similar as with the forward price, where the long position in the forward depended on an investment in the underlying asset and borrowing money. And in this chapter, we're going to look at another very powerful equation called the put-call parity, where we replicate a European call option using both the underlying asset, the risk-free asset, and a put option, or equivalently, we can replicate a European put option using underlying asset, risk-free asset, and a European call option. So how do we do this? Let's imagine that we want to replicate a long position in the risk-free asset, or in other words, buying a zero coupon bond with a face value of K dollars. That means at the maturity date, that zero coupon bond pays us K dollars, no matter whether the price of the underlying is below or above K. And we're going to replicate this by buying a put option, selling a call option, taking a long position in the underlying asset, and then deal with potential dividend payments in that underlying asset by borrowing money against these dividends. So if you buy a put option, then at the maturity date, we're only going to exercise that put option if the price of the underlying is less than K dollars. So that means we receive strike price K and we deliver that underlying asset. So the payoff is K minus S. And if the price of the underlying is above K, then we're just not going to exercise that put option, because otherwise we will get a negative payoff. So if we don't exercise, then our payoff is just zero. For a short position in the call option, that means that we know the long position in the call option will exercise that option if the price of the underlying is above K dollars. So that means for us as the short position, we do have to deliver that underlying asset, so minus ST dollars, and we receive the strike price, so minus minus is plus K dollars. If S is larger than K, but if S is less than K, then we know the long position will not exercise that call option, and therefore our payoff as the short position will just be zero. when we buy the underlying asset, then we have that underlying asset at the maturity date, which is worth ST dollars, plus then I add to that the present value of the dividends between time small t and time capital T. I multiply that by how much the risk-free asset earns to basically transfer that present value of these dividends at time small t to the future time at time capital T. So reinvesting the dividends at the risk-free asset until time capital T yields you this amount of money. And notice that I write exactly the same formula of the underlying asset plus that reinvestment of all the dividends until time capital T, both in the case where S is less than K or S is larger than K. And then finally, if we borrow the present value of dividends at time small t, then at time capital T, we have to return that borrowed amount of money plus interest, and that's that negative cash flow over here. And this negative cash flow is going to be exactly the same whether the price of underlying asset is less or more than K. So if we add up the payoffs of long put, short call, long underlying, and borrowing present value of dividends, then we see that minus ST cancels out with plus ST over here. And this future value of the dividends cancels out with the money which you have to pay back plus interest. And similar in the case where ST is larger than K, we have again ST cancels out from the payoff in the short call option with that stock which you hold until to maturity, and the reinvested dividends cancel out exactly with the amount of money which you have to pay back from borrowing the present value of dividends at time small t. And eventually, if you add up everything, all you're left with is exactly K dollars. And notice this is exactly the same as what you get if you bought a zero coupon bond with a face value of K dollars at time capital T. Since these two strategies of buying a zero coupon bond or buying a long position in put, short position in call, buying 1 unit of the underlying asset and borrowing the present value of dividends, since both of these strategies have exactly the same payoffs, no matter what happens to the underlying asset, therefore the initial price of these two strategies have to be the same. And that's our no arbitrage equation over here. So the value of the zero coupon bond at time small t with face value K is just K discounted by the risk-free rate from capital T back to small t. And then the price which you have to pay for a long position in the put is P dollars. Then the amount of money you receive from short selling the call is C dollars. And then buying 1 unit of the underlying asset is ST dollars. And borrowing an amount equal to the present value of dividends is D dollars. And this no arbitrage equation is the put-call parity. Notice we can also draw the put-call parity in a payoff diagram. Let's draw at the maturity date the price of the underlying asset on the horizontal axis, and then we look at our payoffs on the vertical axis. If you own a put option with strike price K, then at the maturity date, our payoff will be the 45-degree line, where we earn K dollars if the underlying asset price is 0, and we get $0 when the price of the underlying is exactly equals to the strike price. And similar, if the price of the underlying is above the strike price, then we're not exercising that put option and the value is 0. Short selling a call option means that the long position is not going to exercise that call option when the price of the underlying is below K. So that means we get a 0 payoff. But then once the price of the underlying goes above K, then we get a payoff which is equal to that negative 45-degree line. So that means that if the price of the underlying asset is, for example, here, then we know that the long position wants to exercise now that option, meaning that we have to deliver the underlying asset worth this many dollars. and we only receive the strike price K, so we lose this amount of money, and that's exactly drawn on the 45-degree line over here. Finally, the payoff of owning 1 unit of the underlying asset is given by that increasing 45-degree line, which says that, well, if the price of the underlying asset is this many dollars, if I sell it in the market, then I receive exactly this many dollars, which is then given by this point on that 45-degree line. If I add up the payoff of the put at maturity date, the payoff of the short position in the call option at maturity date, and the payoff of owning that underlying asset at maturity date, then we're going to end up exactly with a horizontal line. And notice this is because that decreasing 45-degree line offsets exactly with the increasing 45-degree line, and therefore we just stay always at a level K over here. And then similar, this increasing 45-degree line further offsets exactly with the decreasing 45-degree line, and therefore our total payoff continues exactly at a value of K dollars. And therefore this is exactly the same as having a bond with a face value of K dollars. Notice that the put-call parity only holds for European options because we compare our payoffs at only the maturity date. If we had American options, then there might be the possibility that an option is exercised early, and therefore our payoffs would not all be made at the maturity date, or cash flows which are made early would have to be reinvested until to the maturity date, and our argument would not add up anymore. Another important thing is that the put-call parity only holds for put and call options which have exactly the same strike price. So if your put and call options have different strike prices, well, then our strategy will not add up anymore to exactly yield K dollars at the maturity date. And then finally note that we can also write the put-call parity instead of using the discrete dividend payments at discrete point of time, but by using a flow of dividend payments given by Q. To make this argument, let's go back to the virtual whiteboard and let's draw a timeline from small time t to time capital T. And let's replicate again a long position in the risk-free asset, or in other words, buying a zero coupon bond with face value K dollars. Buying that bond costs today K discounted by the risk-free rate, and in the future it pays exactly K dollars. We replicate that long position in the risk-free asset by taking a long position in a put option, which costs today PT dollars. And in the future, if the price of the underlying is less than K, then we exercise that option, we receive K dollars, and we deliver that underlying asset, which in this case is a positive payoff. But if the price of the underlying is more than K dollars, then we do not exercise the option because we do not want to deliver something worth ST dollar and only receive strike price K, and therefore the option expires worthlessly and the payoff is zero. In addition to that, we take a short position in a call option, and therefore we receive today CT dollars, which we can subtract from the overall amount of money which we have to pay. And the short position in the call means that if the price of the underlying is less than K, then the long position will not exercise that call option, and therefore we do not have to deliver that underlying asset, and the payoff is zero. But if the price of the underlying asset is above K, then we know that the long position will exercise the call option, and therefore we have to deliver that underlying asset, which costs us ST dollars, and we receive the strike price K. And then in addition to that, we buy e to the power of minus Q times capital T minus small t units of the underlying asset. This costs us today how many units we buy multiplied by the price per unit. And if we reinvest all the dividend payments from time small t to time capital T, this means that we have at time capital T exactly 1 unit of the underlying asset, and that will be worth ST dollars. And notice that that formula is the same whether ST is larger or smaller than K. So let's add up everything. So we have here K minus ST plus ST, so this is equal to K dollars. And if ST is larger than K, we have K minus ST plus ST, again equal to K dollars. At time small t, adding up the costs which we have to pay, we get the put price which we have to pay minus the value of the call which we receive from short selling plus the amount of money which we have to pay to buy e to the power of minus q times capital T minus small t units of the underlying asset. And so again, because this whole strategy yields exactly the same amount of money, K dollars, as buying a risk-free bond with a face value of K dollars, that means that the price today of that strategy has to be exactly equal to the price of buying this zero coupon bond, which is K discounted by the risk-free rate. And this formula is exactly the same as what we have on slide 20. So you can derive the put-call parity either with discrete dividends paid between time small t and time capital T, and then you deal with the dividends by borrowing against these dividends, or you can derive the put-call parity if you have a flow of dividends as a percentage of the underlying price, and then you deal with the dividends by buying not exactly 1 unit, but e to the power of minus q times capital T minus small t number of units, and reinvesting all the dividends in the underlying asset so that you end up exactly with 1 unit at the maturity. Either way, both derivations yield us with an equivalent formula for the put-call parity. In one case, we have put price minus call price plus the price of underlying asset minus the present value of dividend. In the other case, you have put price minus call price plus price of the underlying asset discounted by that dividend yield. And in both cases, this is then equal to the present value of K dollars, or that amount of money which you have to pay for that zero coupon bond with face value of K dollars. Finally, notice that we have derived our put-call parity by replicating a long position in the risk-free asset by taking long position in put, short position in call, and long position in the underlying asset, plus dealing with the dividends. You could, of course, also replicate equivalently a short position in the risk-free asset. Then you just reverse all these signs in the above equation, and replicating that short position in the risk-free asset, or in other words, borrowing money, could be replicating by taking a short position in the put, long position in the call, short selling that underlying asset, and again, dealing then with these dividends, which you have to compensate for short selling the underlying asset. You could, on the other side, also replicate the long position in an underlying asset, the short position in an underlying, or you can replicate either long or short position in the call, or long or short position in the put, just by rearranging these initial equation, solving for all these different values, either underlying asset, call price, or put price. So all these different formulas, even though it looks a little bit scary at first sight, it's just rewriting this first equation and solving for different variables. Finally, I want to spend some time talking about a few particular option trading strategies. And in all these strategies, we're going to use European options. And I'm going to show you various different payoff diagrams where we combine different options and potentially underlying assets together. And I'm also going to show you what we call the profit diagram, which is the same as the payoff diagram at the maturity, but also subtracting the future value of the initial costs of actually entering in these option strategy. So let's jump right into it. we start with the covered call. So there are two different ways of a covered call. You can either take a long position in the underlying asset, which gives you this payoff given by the increasing 45-degree line, and taking a short position in a call option given by that green line, which is 0 if the price of underlying asset is less than K. And when ST is larger than K, then we know that the long position exercises that option, and we therefore, as a short position, we have to deliver the underlying asset and receive K dollars for it, meaning that we make some loss given by that decreasing 45-degree line. So combining both together, that gives us this red kinked line, and notice that this is exactly the same as a short position in a put option. So you have this decreasing 45-degree line if the price of the underlying is less than the strike price, meaning that as a short position in a put, you receive the underlying asset when it is worth relatively little, and you have to pay K dollar for it. And if the price of the underlying is larger than K, then your payoff is 0. This covered call of a long position in the underlying and short position in the call option, that replicates a short position in a put option. So when we go from payoff to profit diagram, what we do is we have to subtract from all these positions the initial cost which you had to pay times how much the risk-free asset earns until to the maturity date, capital T. So to get that future value of these costs, and notice that there is a slight typo in the slides. Here we should multiply that ST times the risk-free asset return from small t to time capital T, and similar over here, we should multiply that by e to the power of the risk-free rate times capital T minus small t. So that means the 45-degree line from that long position in the underlying shifts downwards. So the profit is going to be exactly 0 when S at time capital T is equal to the future value of what we paid for it. Similar for shorting the call option, here we actually receive some money. So this means our profit is pushed upwards a little bit. So with the short position in the call, we actually make some money if the price of the underlying ends up less than K. But we start to lose money if the price of the underlying increases far enough above K. So taking these costs into account, for buying the underlying asset and how much you receive from short selling the call option, that gives us the profit of that combined position, which is also equal to short selling that put option. So here we're gonna make money if the price of the underlying is above strike price K, and in particular we earn exactly the amount of money equal to the put price at the initial date times what the risk-free asset earns until to the maturity date. But we lose money if the price of the underlying asset decreases far enough, where the negative payoff of that short position in the put option offsets or is larger than what we have received at the initial point in time. Another version of the covered call is where we take a short position in the underlying asset, illustrated by this decreasing 45-degree line. So here I should have a minus sign in front of S. And we combine this with a long position in a call option. And notice if we add up the kinked green line and this blue dotted line, then we get this kinked red line over here. And notice that this looks exactly like the payoff of a put option. So this version of a covered call of a long position in a call option and short selling the underlying yields exactly the same as a long position in a put option. Adjusting again for the initial cost, so moving from payoff to profit, buying the call option actually costs us something. So we have a downward shift in that curve. And so we get a negative profit if the price of the underlying is below strike price, but this profit turns positive if the price of the underlying increases enough and the payoff of the call price dominates the future value of the initial cost. short selling that underlying asset, of course, that means that initially we get ST dollars, and in the future that's worth ST reinvested at the risk-free asset until to the maturity date, capital T. And therefore, we actually make money from the short position in the underlying asset if S decreases sufficiently, but we start losing money if the price of the underlying increases sufficiently. The combined position, which is this long position in a put option, here we make money if the price of the underlying decreases sufficiently and the payoff of that long put position dominates the initial value of the put option brought forward until to the maturity date. And on the other side, we lose money if the put option is out of the money, and we lose exactly an amount of money which is equal to the future value of the price which you have to pay for a put option back at time small t. Similar to covered call, there is a strategy called protective put, where you either combine a long position in the underlying asset and a long position in a put option, which replicates a long position in a call option. And again, if you move from payoffs to profits, you have to downward shift that long position in the underlying asset and downward move that long position in the put option to adjust for the initial costs which you have to pay for that stock or the put option. And therefore also that combined position, that red line, moves downward, and you will have a loss if that call option is out of the money. You basically just lose the initial amount of money which you have to pay for the call option at time small t and bringing that forward until to the maturity date, but you make a gain if the price of the underlying asset increases sufficiently and the call option ends up in the money. Notice again, here's a typo in the slide. So here we should actually write ST times e to the power of the risk-free rate times the time to maturity, because we want to figure out what is the future value of these ST dollars at time capital T. Another version of a protective put is short selling the underlying asset and short selling a put option. This adds up to a short position in a call option, and again going from payoff to profit. We adjust by how much money you receive from short selling the underlying asset and how much money you receive from short selling the put option, and that shifts your positions upwards. And so for the profit diagram, you make some money if that call option which you replicate ends up out of the money. So then you just collect the premium from shorting the call option, but you lose money if the call option ends up in the money, and that payoff to the long position in that call will be higher than the initial amount of money the long position pays you. A bull spread can be constructed either from call options or from put options. Here I start with call options. For a bull spread, you take a long position in a call with a relatively low strike price, and then a short position in another call option with a higher strike price. And if you add that up, it gives you something which looks kind of like a ramp function. And if you go from payoffs to profits, you have to pay relatively a lot for that first option with that low strike price. And then you receive a little bit of money for that call option which you short sell at the strike price K2, but that amount of money is much less than what you have to pay for that option with the lower strike price. This is just a typical property of a call option, that the price of the call option decreases in the strike price, because the higher the strike price, the lower will be the future payoff, and therefore the less you have to pay for that option. That bull spread loses money if the price of the underlying ends up relatively low, and in particular if it is below K1. And you gain money if the price of the underlying ends up relatively high, and in particular you make quite some money if it is above K2. Notice that the downside is limited and the upside is also limited. So therefore the speculation is much less risky than just buying the underlying asset itself, because the underlying asset may lose much more money if the price drops far below K1. Here I write again these payoffs of that bull spread in that table, depending on whether the price of the underlying is below K1, whether ST is between K1 and K2, or whether ST is above K2. What you see is that the payoff at maturity is 0 if S is less than K1, so that's what we had over here. The payoff is ST minus K1 if ST is between K1 and K2. That's this increasing 45-degree line. And the payoff is K2 minus K1 when the price of the underlying is above K2. So that's this horizontal line over here. From this analysis, you also see that because payoffs are always either 0 or positive, it must be that the initial cost is positive, so that the profit may actually be negative in certain states of the world and only positive in others. And in particular, the initial cash flow, which is given by the call price which you receive from short selling the option with the higher strike price minus the call price which you have to pay for the option with the lower strike price, has to be less than 0, but also larger than minus K2 minus K1 discounted by the risk-free rate. Now, where do I get this inequality from? If this negative cash flow was more negative than this amount of money, then the profit in the future would always be negative, because at most your payoff in the future will be K2 minus K1 dollars. Therefore, the initial cost cannot exceed the present value of this amount of money. Otherwise, your profit in the future will always be negative, which would then lead to an arbitrage. Notice that this argument is exactly the same as what we draw over here. It says that the cost is exactly such that we can lose money when the price of the underlying is low enough, but we do earn money if the price of the underlying is high enough. We can also create the bull spread using put options, and that's equivalent to using call options. Here we would buy a put option with a relatively low strike price, and we short sell another put option with a higher strike price. You get exactly the same pattern. You have this horizontal line, then you have an increasing 45-degree line payoff, and then you have a horizontal payoff again if the price of underlying is above K2. For your profit diagram, you actually pay less money for the put option with a low strike price than the money which you receive for the put option which you sell with the higher strike price, and therefore your combined payoff, this red line over here, shifts somewhat up, and again you're going to end up with a loss if the price of the underlying decreases sufficiently, but you make a gain if the price of the underlying increases sufficiently. So this is exactly the same as we had with the bull spread using call options. So it's again a speculation that the price of the underlying increases, but you have a limited potential gain, but also a limited downside in case the underlying asset decreases a lot. And again, on slide 28, I write down these payoffs in this table over here. And from this, you see, because all these payoffs in the future are negative or 0, that must mean initially we receive a positive payoff, and that positive payoff will be bounded between 0 and the present value of K2 minus K1. If the initial cash which you receive, if that was larger than this amount of money, then in any state over here, we would always end up with a positive profit, and therefore there would be an arbitrage. So in other words, that's again representing exactly the same as what we have the picture over here. So we will have a negative profit or a loss in certain states in the world, and in other states in the world, we do have a positive profit. Similar to bull spreads, we have bear spreads, and again we can do these either with call or put options, and bear spreads are going to be speculations that the price of the underlying decreases instead of increases. You can do that using call options, where you take a short position in a call option with a relatively low strike price, and you take a long position in a call option with a relatively high strike price. The combined position will look like this red line over here. And if you factor in the initial costs for these call options, then the amount of money which you get from short selling a call option with a low strike price is higher than the amount of money which you have to pay to buy a call option with a high strike price, and therefore you can shift upwards that red payoff diagram to get a profit which looks like this over here. So this means you make a profit, but it is limited if the price of the underlying decreases, and you make a loss if the price of the underlying increases, but that loss is limited. So in that sense, it is slightly different than just short selling the underlying asset, because your upside and your downside are both limited. Slide 30 illustrates the same argument of what I draw with that table, and I'm going to leave that just for self-studies. Then we can also construct exactly the same bear spread using put options. So here we short sell a put option with a relatively low strike price. We buy a put option with a high strike price. The combined position is given by that red line over here. And here the amount of money which we receive from short selling the put option with the low strike price is much less than what we have to pay for the put option with the high strike price, and therefore we can shift downwards that red curve a little bit to get our profit diagram. But at the end of the day, it is exactly the same as when we construct a bear spread using call options. It's a speculation that the price of the underlying decreases, where you then receive a profit, and on the other side, you lose money if the price of the underlying increases. And on slide 32, I have the same argument as in these drawn pictures, again, just using a table to write down these payoffs and then also figuring out bounds on the initial costs. A box spread is a combination of a bull spread using call options and a bear spread using put options. And in particular, you want to choose these bull and bear spreads with the same strike prices. So you buy a call option with strike price K1 and sell a call option with strike price K2. So that gives you the bull spread. And then you combine that with that bear spread, where you sell a put option with strike price K1 and you buy a put option with strike price K2. Adding up everything, you're just going to end up with a constant payoff, which is equal to K2 minus K1. Therefore, a box spread just replicates the payoff of a zero coupon bond, and the initial cost of implementing that box spread has to be equal to the present value of K2 minus K1. The butterfly spread can be implemented either using call or put options. Let's start with call options. You would buy a call option with a low strike price K1. Then you buy another call option with a high strike price K3. And you short two call options with intermediate strike price K2. That gives you this tent-shaped payoff diagram. And in particular, you get a high payoff if the price of the underlying ends up somewhere close to K2, and you get low payoffs if the price of the underlying ends up either below K1 or above K3. Notice for the profit diagram, buying the call option with a low strike price is expensive. Buying the call option with a high strike price is relatively cheap. And the money you get from short selling these two call options and intermediate strike prices have some price somewhere between the other two call options. At the end of the day, the profit has to be in such a way that in some states of the world you get a positive profit, and in some states of the world the profits are negative, otherwise there would be an arbitrage opportunity. In the particular way I draw it over here, you lose money if the price of the underlying decreases sufficiently or increases sufficiently, and you make a profit if the price of the underlying stays somewhere close to K2. I can also write this in a table over here. In particular, here I assume that K2 is exactly in the middle between K1 and K3. So if the price of the underlying ends up less than K1, then all the 3 call options have 0 payoffs, none of them will be exercised, and the overall payoff is 0. If the price of the underlying is between K1 and K2, then that first call option which you buy, you will exercise that, and your payoff is going to be ST minus K1, which is a positive payoff. And the other 2 call options are not exercised and have 0 payoffs, so your combined payoff is going to be ST minus K1. So that gives you that increasing 45-degree line segment. Then if the price of the underlying is between K2 and K3, now you still keep receiving ST minus K1 from that first call option which you buy, but now you lose 2 times ST minus K2 from the 2 short positions in the call options with strike price K2. So in this case now your counterparty will exercise the option and you lose the 2 options which you short sell, each you lose ST minus K2. So what is the combined effect? It's going to be 2 times K2 minus K1, and then the ST over here cancels out with one of the STs over here. So you have 2 times K2 minus K1 minus ST. And notice that 2 times K2 minus K1 is exactly equal to K3 if we assume that K2 is exactly between K1 and K3. So that's that final payoff which I write over here. And notice that this is decreasing in the price of the underlying asset, and that captures that decreasing 45-degree segment over here. Visually, what does it mean? Well, you have still, and you gain by this increasing 45-degree line, but now you have 2 times this 45-degree line, which is decreasing. So overall, this payoff causes a decreasing 45-degree line. And then finally, if ST is above K3, then now all the options are exercised. And on top of the other 2 option payoffs, now you receive ST minus K3. If you add up everything, this yields exactly 0. And again, this is the special case where K2 is exactly in the middle between K1 and K3. In the case over here, actually, we get a negative payoff because K2 is actually somewhat closer to K1 than to K3. Now, if you look at this particular butterfly spread, in this case, we actually always have a 0 or positive payoff. And therefore, in this specific case, the initial cash flow over here has to be negative, such that there is no arbitrage. At the end of the day, this butterfly spread is a speculation that the price of the underlying asset adds up close to K2. So that's where you receive a payoff close to K2 minus K1. Similar, we can take a butterfly spread position using put options. Here we would buy a put option with a low strike price, buy another put option with a very high strike price, and sell 2 put options with intermediate strike prices. Adding up everything, again, you get this tent-shaped picture over here. The best way to see it is start with a very high price of the underlying asset where all the put options are out of the money. Well, then the payoff is just 0. Now, if the price of the underlying is below K3 but above K2, then you only exercise that first put option, and so you gain money as the price of the underlying increases. Now, once the price of the underlying drops below K2, you still keep gaining from that first put option, but now you lose twice from these put options which you short sell, which reverses here your payoff to a decreasing 45-degree line until to a level K1. If the price of the underlying decreases below K1, now you twice earn from put options which have an increasing payoff at a 45-degree line, and you lose twice from put options that is decreasing 45-degree line, and it cancels out back to a horizontal line. Notice in this case with the put options, your payoff is always positive. So therefore it has to be that the initial investment costs you some amount of money, which then causes the profit to shift downwards. And therefore you get this pattern. Again, you lose money if the price of the underlying either decreases a lot or increases a lot. And you make some profit if the price of the underlying stays close to K2. Another interesting strategy is the calendar spread. Here you sell a call option with a relatively short time to expiration, and you buy another call option with the same strike price but a longer time to maturity. The payoff of the short position in the call which you short sell is given by this kinked line over here, while the value of the long position in the call option with the longer term to maturity is given by this curved line over here. Combining these two positions gives you again a tent-shaped picture which is similar to a butterfly spread. Again, you lose money if the price of the underlying decreases sufficiently or increases sufficiently, and you make money if the price of the underlying doesn't move much and stays close to the strike price K. A calendar spread can also be created using put options. Here you would sell a put option with a short term to maturity that's given by this kinked line over here, and you combine it with a long position in the put option with the same strike price but a longer term to maturity, so then the put price has still also some time value left and is given by this curved line. Combining the two gives you again this tent-shaped figure over here. And again, you lose money if the price of the underlying either decreases a lot or increases a lot, and you make a profit if it doesn't move much and stays close to strike price K. For butterfly and calendar spreads, typically we choose the strike price K2 for the butterfly spread or K for the calendar spread, close to where the price of the underlying is right now. And therefore the speculation is really just that the price will not move a lot. Finally, notice that for the butterfly spread, when K1 is close to K2 and K3 is close to K2, then that tent-shaped figure becomes very tiny and just has a small spike at the value K2. And so eventually you get a strategy which only makes money if the price of the underlying is exactly equal to K2, and otherwise you lose money. And this is an interesting concept when we get later in our course to the theory about Euro-Debreu securities. A straddle is basically the opposite of a butterfly spread. So here you speculate that the price of the underlying moves a lot and either decreases or increases a lot. And you do that by buying a call option with strike price K, and at the same time buying a put option with the same strike price K. Notice that buying call and put option cost you something. So for your profit diagram, you have to shift that red V-shaped payoff downward. And so you see that you make a loss if the price of the underlying stays close to K, but you start making a gain either if the price of the underlying increases sufficiently or decreases sufficiently. In other words, the straddle is a speculation that the price of the underlying moves a lot, but you don't really know in which direction it's going to move, whether it's going to decrease or increase. On slide 41, I'm going to summarize exactly the same as what we have seen in the previous slide in the figure. I just write these payoffs in a table. Strips and strap, they're similar to a straddle as they are a speculation that the price of the underlying will move a lot. But here you actually have some expectation whether the price of the underlying decreases or increases. For strips, you take more than one position in put options. So let's say you buy n number of put options and you only buy one unit of the call option. Now you got a much steeper line of profits if the price of the underlying decreases, and you only get that 45-degree increasing line if the price of the underlying increases. So again, you make losses if the price of the underlying doesn't move much. You make a lot of profits if the price of the underlying decreases, and you can make some money if the price of the underlying increases. So in that sense, you speculate that there is a big movement, but definitely you have some prior that it is more likely that you have a decrease in the price of the underlying, and therefore you reap a lot of profits if the price of this underlying drops a lot. On the other side, straps are a combination of n number of call options and one put option, the mirror image of strips. And here, similar like strips, you lose some money if the price of the underlying doesn't move much and stays close to strike price K. On the other side, you reap very large profits if the price of the underlying increases, and you may also get some moderate profits if the price of the underlying decreases. So in that sense, again, it's a speculation that the price moves a lot, but it is better if the price increases, because that's where you get much more profits. But if it decreases a lot, you may also get somewhat moderate profits. Finally, we have the strangle. The strangle is again a combination of put and call option, but here you buy a call option with a high strike price and a put option with a low strike price. This is again like the straddle, a speculation that the price of the underlying moves a lot, but here you only get payoffs if the price of the underlying either increases above K2 or decreases below K1. The strangle will be cheaper than a straddle because it is cheaper to buy a call option with a relatively high strike price and a put option with a relatively low strike price. Therefore, the losses which you get if the price of the underlying doesn't move much is less than what you would have with a straddle over here. But on the other side, the price of the underlying has to move more up or down until you see some profits. At the end of the day, when you decide between strangle and straddle, it depends on whether you want to have a lower initial investment, then you go with the strangle. But on the other side, if you want to have potentially larger profits, if the price moves, then you want to go with the straddle. And this concludes this chapter for today.